So while, by no means was the sky falling in LA, prices had just run up for so long. Pair that with the slowing pace of rent growth, and you did see, especially in kind of the eastern part of the county, overall slowing in investment volume and properties sitting on the market longer, as you identified.
Hi, this is Chris German from The Apartment Dealer. Welcome back to The Apartment Dealer Show. This is where we bring you the resources, the information, the network of professionals that can help you and aid you in the building of your financial legacy in multifamily investments. Here with me today is Mr. Steve Basham. Steve is with the CoStar Group. If you're unfamiliar with the CoStar Group, it's the nation's leading source for all data points when it comes to commercial real estate. To give you some idea, every major commercial brokerage firm utilizes CoStar's analytics as part of their daily brokerage. Some further insight in terms of how much data is it that they are tracking. Daily, they're tracking 5.1 million data points, and they're tracking 6 million commercial properties on a daily basis, just to give you some idea of the depth of the information that they have at their disposal. And Steve is actually the managing analyst here in Los Angeles County, has been with CoStar Group for nearly 15 years. So brings with him not only that storehouse of data points that CoStar only he has access to by being affiliated with CoStar, but is here with us today to empower you, the landlords, in terms of what has happened during this entire health crisis. 2020 has proven to be a new kind of year. And as we move into the new norm, we need to be able to adjust, to pivot based upon not emotion, but on the facts. What does the data tell us exactly what's happening in the commercial real estate industry today, specifically to multifamily? So Steve, thank you and welcome to the Apartment Dealer Show.
Happy to be here. Thanks for having me.
So for our viewers, those that are questioning, okay, hey, I stay on top of CNN Money, I'm looking at Forbes. How's CoStar differentiated from those other financial resources?
CoStar is concerned exclusively with commercial real estate and multifamily properties. So we are third-party independent information. We are not involved in the leasing or selling or development of any type of property or commercial asset. We're strictly an information company, and our role is to provide third-party independent information to the commercial real estate industry so that our clients can make the best decisions, the most informed decisions based on the best.
So in other words, you don't have a dog in the race. Whether someone chooses to buy, sell, or hold, CoStar doesn't profit any. You're there just to serve the landlords and the brokers in terms of the real analytics.
Exactly. We guard that independence scrupulously. We value our role as the independent third party. So we're not financially affiliated with any brokerage or other entity in the industry, and that allows us to really provide an independent third party view.
Okay, Steve. So what I'd like to do is frame our conversation today. Three major segments, easy to remember: BC, DC, AC. Before Corona, during Corona, after Corona. Because obviously that really is three major parts to the market as we're experiencing it today. So in March, all right, let me back up for a moment. So over the last 10 years, I've conducted live educational seminars, luncheons for apartment landlords. And we've had several thousand investors come through our events. And the analytics we've always used has come from CoStar. So when it's my time to take the stage in between the lawyers and everyone else, the data points we're sharing is all the data that we collect from CoStar in terms of sales trends, price per unit, and so forth. Now, our last event was in March. And in gearing up for that event, we had collected a 10-year run on what had sales volume looked like and where were property values headed, not knowing that my event was actually on March 19th, not knowing the governor the next day would announce the stay-at-home order, and turn, the economy, almost into a tailspin, there for a moment. And so I mentioned that and preface that because, again, this data, it was all prior to any of us knowing that this health concern would enter into the market. And I think that's important because we already saw certain things taking shape in the market. And I would argue that this health concern has just exacerbated what was already kind of showing itself in the market. So the first thing we'll move to is overall sales volume. The overall sales volume, and we chunk it down by various corridors. So we have the 710-91 corridor. So this is going to be your Huntington Park, Maywood, Southgates, kind of like that lower end, of the South LA area there. We have the 605 corridor, Montebello, Whittier, Pico Rivera, Norwalk, through those areas. The Eastern San Gabriel Valley, which really is basically between the 605 and the 57 freeway. East Los Angeles, which is East Los Angeles, El Sereno, those surrounding areas. Pasadena, which we bring together, Altadena, South Pasadena, Sierra Madre. West San Gabriel Valley, so this is going to be the San Gabriel Valley, essentially between the 710 and the 605. And then the Inland Empire, West Inland Empire, essentially everything from Pomona up to about Ontario, and then east of there. So we chunk it down by corridor. And all someone has to do is take one glance at these charts to understand that sales volume has been dropping off significantly since 2017. So the fact that, of course, the market has slowed here currently, but the market in terms of deals the number of deals that were turning year over year had already slowed again since 2017. Now, as we move to, in terms of what have values done here recently, where were they trending? The first corridor we can move to is to the 605 corridor. So again, we see there on the chart on the left, sales volume depicted by the bar graph had slowed down since 2017. Price per unit had continued to edge up slightly, but if you look at the months to sale, or how much time was it taking for properties to sell on the right-hand side there, you see that the days on market had began to tick up. And that really becomes a theme. If you move to, say, the Eastern San Gabriel Valley, same thing, sales volume had dropped off, prices had peaked out as depicted by the line graph on the left, and you look at days on market, it had began to climb beginning in 2019. Same thing if you go to East Los Angeles, sales volume drops off, you have prices continuing to edge up slightly, maybe a few outlier sales, but it definitely was taking properties to sell, taking properties that much longer to sell and move. The Pasadena area, sales volume had dropped way off, and it was, again, properties were spending much more time on the market in terms to get them to sell. The Western San Gabriel Valley, now here, the price per unit had already dropped beginning in 2018, and days on market, again, we saw it climbing, and of course, sales volume had dropped off as well. And then the 710-91 corridor, in this area, I would argue, because the other areas had gotten so expensive and investors chasing yield, you still had price per unit being pushed up. The last 2 years, sales volume overall had stayed about the same. And again, this, as we'll see also in the Inland Empire, in my opinion, was a reflection of investors really chasing yield and moving out of the San Gabriel Valley into other areas that had, climbed well over 300,000 per unit. When you get into the Inland Empire, prices had been steady the last couple of years. Not as many deals trading, but prices had not dropped off. And yes, properties were on the market a little bit longer, but not that much longer than we had noticed over the last 2 years. And then the Inland Empire East, you have both sales volume jump and price per unit jump. Again, as investors, we're looking to chase yield. When I say chase yield, essentially net income, cash on cash, higher cap rates. Many of them moved east, and so that just, supply and demand drove those prices up. So again, these everything I've shared here is CoStar Analytics. Steve, if you want to give a reflection, or even if you have a counter viewpoint to what I see as the under thread here, what would you say these charts have told us of what was happening prior to March?
I think you've really identified the key point in pointing to values running up and affordability. Most of those charts that you just showed, in almost all of those areas, showed average unit pricing doubling or more than doubling over the past decade. It was really an impressive run for the LA multifamily market in terms of pricing and value growth, and that kind of grew out of how rents grew over that time. But in the last few years, 2018, 2019, while rents were still growing at a healthy clip, the pace of growth has slowed down quite a bit from what we'd seen earlier in the decade, in 2015, 16, 17. And as rent growth slowed and prices continued to rise at a pretty steady clip, the overall yield, as you mentioned, began to shrink for the average investor. So especially for, we didn't see quite the same drop off in investment on the west side of LA, where a lot of the high-end institutional product is located. Your national investors and deep-pocketed investors were still interested in LA product, but as cap rates compressed and yields compressed and the overall return on investment got smaller, you saw fewer and fewer areas there where the investment picture was compelling, especially for maybe more of the private investor that doesn't have that deep reserve of cash and capital to draw on. So while, by no means was the sky falling in LA, prices had just run up for so long. Pair that with the slowing pace of rent growth, and you did see, especially in kind of the eastern part of the county, overall slowing in investment volume and properties sitting on the market longer, as you identified.
So let's talk rents there. And of course, we're talking about rents prior to this health concern that we're currently in. Is it a simple case of renters had began to use more and more of their discretionary income? A lot of things I read say up to 55% of their discretionary income. And when you pair that with stagnant wages, there's only so much that they could pay. I mean, is it as simple as that? Is that why we haven't seen rents continue to run the way they have?
I think so. So generally, when you look at slowing rent growth, the usual culprit is vacancies increasing, right? That is typically the thing that weighs on rent growth. But that wasn't the case in Los Angeles. Prior to the outbreak, overall apartment vacancies remained extremely low, around 4.5%, one of the lowest rates of any metro in the entire country. Despite that, we saw rent growth slowing. And so because the vacancy picture was so tight, the affordability that you mentioned is absolutely the main culprit and the main suspect in that slowing rent growth. You had years and years earlier, last cycle in the decade, where apartment rents grew by 4, 5, 6% year over year, and incomes just weren't growing that fast. Even though the economy was healthy, the housing costs and rental costs were outpacing the rate of income growth. That's just not sustainable over the long term. We had 3, 4, 5 years where rents really grew much faster than incomes. And I think what you saw in the last year or two prior to the coronavirus outbreak was growth, despite the tight vacancy picture, starting to return to a more sustainable level, more in line with income growth, because the average renter and the average renting household just can't dedicate more of their income to rent in Los Angeles. When you look at one important indicator, that the cost of rent versus average household income, Los Angeles is the most expensive metro in the entire country. Housing costs are higher in places like San Francisco and New York, but average incomes are much higher there too. So when you look at that spread between what people earn and what they pay to live or to rent, that spread's more pronounced in Los Angeles than anywhere else in the country.
To summarize again, even without the current health concern, sales volume had dropped off. Prices at best had hit their peak, but in many subcorridors had begun to decline, and it was taking properties longer to sell on the open market. So that's where we were, before this pandemic hits. So now we're post March, and I know you have a good amount of analytics you're going to be sharing with us, but I thought this would be interesting. So we actually took a poll of some of our loyal viewers in terms of two things here. One, what percentage of their rent was collected in the month of July? And second, essentially, what is their sentiment currently of the market? Are they pessimistic or optimistic? And what our poll found was that 83% of the respondents in July collected at least 90% of their rent or more. And only 5% of the respondents collected 80% or less. Now, is our poll reflective of what you're finding in the market at large, that even with tenants being encouraged not to pay rent, if you will, by politicians, they have essentially continued to pay?